Signing up with the right brokerage is key. While you definitely don't need to be a PhD in financial engineering, the analytics and features that I talked about in this video are basics that you absolutely need to have in a brokerage in order to make good decisions about what trades to make or not make, etc. What is up, everyone? I'm Rose and welcome back to my channel. In this video, I want to talk about the best app and brokerage for trading options. And no, it is not Robinhood. Just for the record, Robinhood is the worst brokerage ever, but we will get into that. This video is video number 3 in a 6-week series about options trading. So if you're new around here, make sure to catch up on that playlist right here because each video builds on the last and the whole series is meant to get you up to speed on all things options trading. Also, don't forget to subscribe and hit the notification bell so you don't miss any upcoming videos. In this video, I'll be talking about the 3 criteria to look for when choosing a brokerage to trade options at. Some of these criteria include what kind of trading analytics you need in order to make income-generating options trades, how the fees and commissions work, and some other important factors that can make or break your options trading side hustle. And of course, I'll also share what app I use and what I consider is the best one for trading options. So with that, let's get into the video. All right, so first and foremost, you want a brokerage that offers the right options trading analytics. What I mean by that is there are some basic metrics and tools that you need in order to set up income-generating options trading strategy. Although you won't be using all of these features right away when you're starting out as a beginner, you do want an app that you can grow into and that already offers some of these metrics. 2 of these essential metrics are probability OTM and IV percentile. If that sounded like gibberish to you, that is okay because it actually is gibberish, and I'm going to explain everything to you right now. Let's first start with the probability OTM, which actually stands for the probability of expiring out of the money. Probability OTM for short. To understand probability OTM, we need to rewind a bit and talk about what out of the money and in the money means. If you're already familiar with these terms, just feel free to skip ahead to the next section. The timestamps are right below in the description. When an option enables you to transact on the underlying stock for a better price than what you can get anywhere else, then that option is what you call in the money. For example, let's say you buy a call option on Apple with a strike price of $100. This means that you have the right to buy Apple at the strike price of $100 anytime before the expiry date of that option. If Apple starts going up all the way to say 150, then that call option is in the money. It's just the way it sounds. In the money means you're literally in the money, like you're rolling in it, because you own an option contract that enables you to buy the stock cheaper than the actual market price, therefore pocketing an immediate $50 profit on that stock. So in the money means success if you are the buyer of that option. So if you owned that call option and it ended in the money, successful trade for you. And then for the seller of that option, it would be failure, or they would lose money on that trade. It's just common sense, right? If a trade turns out well for the buyer, it's gotta be bad for whoever's on the opposite side of that trade. So good for buyer equals bad for seller. Now, what if that Apple call option you bought ended up being out of the money instead? So let's talk about what out of the money means. Let's say your call option has a strike price of, again, $100, but this time Apple stock went down, all the way down to, I don't know, $60. Well, nobody wants to pay a higher price for something than what it's actually trading for on the open market. So this call option would become worthless or out of the money because you're not going to exercise on an option that allows you to buy something at 100 when it's actually trading at $60. Nobody wants to pay more for something than they have to. Now, options aren't free. Whenever you buy an option, you have to pay money out of pocket in order to buy that option in the first place. And this money that you pay to buy the option is called the premium. So whenever you buy an option, you pay the premium in the hopes that the option will end in the money and result in you making back the premium plus a bunch more profit. But if the option ends out of the money instead of in the money, then you actually lose all the premium that you paid because that option will end up being worthless. So again, for the buyer, out of the money means failure, whereas for the seller of that option, the person on the opposite side of that trade, out of the money means success. By the way, if you could use a primer on these concepts, make sure to watch this Options 101 video right here. It's a really good beginner explainer video on calls and puts and all the basics. So now you know what in the money means and out of the money means. So if one scenario means failure and the other scenario means success, then don't you agree that it would be very useful to know how likely it is for either scenario to happen? The good news is that you can. If you look at the history of a stock and how it's behaved in the past, you can actually get a pretty reliable idea as to how much that stock will move in the near future. Using statistical analysis, a bunch of nerdy stuff, a good brokerage will crunch a bunch of historical data for you and spit out a metric called probability OTM, or probability of expiring out of the money. You can view probability OTM as the probability of success or the probability of failure, depending on whether you've bought the option or you've sold the option. So with this information, you can make it part of your strategy to only make high probability trades. For example, whenever I sell options, I aim to only sell options with a 70% probability of success or higher. This means that 70% of the time my trades will make money, which is great, but the only way you can do this is if your brokerage provides these probability OTM numbers for you. So that is probably the first and most important kind of analytic metric that you need your brokerage to provide. Another important options trading metric to look at is implied volatility, or IV for short. Implied volatility, or IV, is a number that signals the magnitude of ups and downs expected for a stock in the coming months and days. If IV for a stock is very high, that means people are expecting quite the roller coaster ride for the stock price in the coming days. And if IV for a stock is very low, that means people aren't expecting the stock price to move much or have much excitement in the coming days. When implied volatility is high, options become very expensive. And when it's low, options become very cheap. That's just because of the way option prices are determined, and implied volatility is a huge factor in whether options are expensive or cheap. So it's good to look at implied volatility when trading options so that you know how expensive or cheap the option is before you do anything with it. For example, if IV is high, you probably wouldn't want to be buying any options, since that would mean options are generally very expensive. You don't really want to be buying things when it's an expensive time. However, since some stocks are much more volatile than others, the best way to measure implied volatility is actually to look at its percentile, or IV percentile. I'm not going to get into all that in this video, but basically, in order to choose the best stocks to trade options on and the best option strategy to use, you need to look at both implied volatility and implied volatility percentile, which is sort of the relative version of implied volatility that allows you to compare IV levels across all different stocks and sort of compare apples to apples. So make sure that whichever app you end up using to trade options with provides all of these metrics. The second criteria to look for in an options trading brokerage is low fees and commissions. This isn't as much of a concern these days since brokerages as a whole have started moving towards just $0 commissions, but it's still worth mentioning because just because a brokerage offers free trading doesn't necessarily mean it's the best. For example, Robinhood is an app that is hugely popular with millennials and Gen Z because of its free stock and options and crypto trading. However, there's a lot of reasons why I'm against Robinhood. First of all, you get what you pay for. Robinhood doesn't offer many of the options trading analytics that I talked about, and so it's going to be hard to properly trade options, or at least to do it in a way that would generate income consistently and safely, such as they don't offer probability OTM, they definitely don't offer IV percentile, so these are not things you'll get at Robinhood. Not only this, but there's been a ton of bad press about Robinhood and its shady practices. Recently, it was fined $70 million by FINRA, which is the largest penalty ever because of Robinhood's misleading communication and trading practices. Not to mention that time a 20-year-old college student committed suicide after mistakenly believing that he'd lost $730,000 on an options trade because of the confusing way Robinhood displayed his account balance. Such a nightmare story. I mean, all I have to say is what the why was this guy not able to get in touch with customer service, and why was there such a huge misunderstanding? It's really tragic. Robinhood has all this convincing marketing about their mission to democratize finance, but honestly, it seems like they're on a mission to democratize gambling. Otherwise, why would Robinhood offer margin trading accounts, which is an account that allows you to trade with borrowed money, yet they don't even offer Roth IRAs, which is like the most basic building block of financial security for young people. Everything about Robinhood leaves a really bad taste in my mouth. Enough about my rant on Robinhood. The real question is, then what is the best app for trading options? Drum roll, please. The best place to trade options, in my opinion, is TD Ameritrade. TD Ameritrade has been around for a long time, and they're known for their award-winning desktop trading app, Thinkorswim, which happens to be great for trading options. Now, Thinkorswim is not as simple and intuitive to use as Robinhood, but that's because it's just much more advanced. It's geared for people who approach options trading as a business versus as some sort of gambling activity. There is a reason why Robinhood's user base is mostly made up of beginners who really don't have a great grasp on what they're doing, whereas Thinkorswim's user base tends to be more serious and experienced. Once you get the hang of it, Thinkorswim is actually quite easy to use, and they also have a really good mobile app that makes it quite easy to place trades and check up on your positions on the go. Now, I will say that trading options at TD Ameritrade isn't free like it is at Robinhood. They charge a 65-cent contract fee for every option trade, but like I said, you get what you pay for. In fact, Thinkorswim is so good that TD Ameritrade recently got bought out by Charles Schwab, precisely because Charles Schwab wanted Thinkorswim. They wanted to acquire a better trading app. So since those two are some of the most reputable brokerages around, that merger is bound to bring on even more improvements as well. Besides, 65 cents a trade is nothing. Back in the day, it used to cost $4 or more per trade when I was starting out. So we're very spoiled these days. The third and final criteria to look for in a trading app is amazing customer service. Anytime your money is involved, you should expect great customer service. As in, you can pick up the phone and talk to a real person about your trade and what's gonna happen to your account on expiry day, what your exposure is, whatever other questions might come up. At TD Ameritrade, I've never had to hold for very long, and even if I call on a Sunday night at 10 p.m., it's always with a very knowledgeable person who actually picks up the phone, and they're not just reading a scripted customer service response. Now, I don't get paid for promoting TD Ameritrade. This isn't a sponsored video or anything. I'm just sharing my experience with them, and I just really think they're the best brokerage out there for trading options. Okay, and because I can't resist taking one more jab at Robinhood, it looks like as of February 2021, they've started investing heavily in better customer service, but I really think they should have started doing this before granting almost $1 million in leverage to this poor 20-year-old guy who committed suicide because he didn't understand what was going on with his trade and he had no one to call. Anyway, you get my point. Signing up with the right brokerage is key. While you definitely don't need to be a PhD in financial engineering, the analytics and features that I talked about in this video are basics that you absolutely need to have in a brokerage in order to make good decisions about what trades to make or not make, etc. So I hope you've enjoyed this video. If you're interested in learning more about options trading, here's what I want you to do next. First, give this video a like for the YouTube algorithm because it helps get this important information in front of more people. Secondly, grab a copy of my free options trading starter kit. It explains the very basics of options trading, and it also has a printable cheat sheet and little quizzes to test your knowledge. People have been emailing me to tell me how helpful it's been, so it's really good. Just click the link below to download it. And finally, this video is part of a 6-week series of options trading, and next week's video will be all about my favorite option trade for generating 1K plus monthly cash flow. So subscribe and hit the notification bell so that you do not miss that video or any other video in the series. Okay, that is it for today. Thank you so much for joining me. Check out my channel for more awesome content on how to seriously up-level your financial literacy, and I will see you next week, same time, same place. Bye!